Welcome to the Hurst Trading Room Live. My name is David Hickson, and I'm very excited to welcome you all to the first ever live Hurst Trading Room webinar. I must tell you, we've spent the entire week grappling with the technical details of pulling off this webinar. We've had a fantastic response. Over 300 people have registered. I hope to see many of them live. Those who aren't able to attend live will be sent a link to the recording. I'd like to say on a personal level, I feel so much gratitude to all of you for your support and for your interest in Hurst cycles. I did my first webinar about Hurst cycles 6 years ago in, I think it was September of 2009. So exactly 6 years later, I'm coming back. Back in those days, we had about 15 or 20 people who would come along to those webinars. I thoroughly, and it is really exciting to be doing this again. So thank you very much for your support, and thank you for being here. Thank you for your interest in Hurst cycles. Just a few quick points. So let's go to that tab first. A few quick points about the webinar room. You can maximize the actual display if you want to reduce the distraction of the chat window, or you simply want to focus on what I'm saying a little more clearly, then you can maximize that display by clicking the maximize button. You can also chat on the left. It's an extraordinary chat window. It provides you with an instant Google translation into your own language. I don't know how good a Google translation is going to be in terms of speaking about Hurst cycles, so that might be entertaining rather than educational, but give it a go and try translating into your own language. Recently, I had a lot of interest in Hurst cycles from people who speak all kinds of different languages, and so I'm hoping that's going to prove to be a useful tool for all of us. Let's get down to it, and as always, before we actually take a look at the markets or start speaking about Hurst cycles, I need to present you with these disclaimers. They are very important, and they are legally obliged, so you should be aware of these disclaimers. It's not necessary for me to read them, which is a big relief. I used to have to read them, but please make sure that you have looked at them and that you have understood them, because all trading does involve, and we are making no guarantees that you are going to endlessly make money. I see some chats happening in some different languages, so I think I'm going to have to turn on the translation into English, and let's see how that goes. The translation into English doesn't look as though it's really going terribly well. Perhaps I'll turn off that translation. Just a quick point about that chat window, because I want to try to make this webinar as full of useful information as possible. I'm not actually going to be following the chat in the chat window. Please be aware of that. I'm not going to be rude. I'm not ignoring you. I'm not going to follow that chat. I pride myself that I can do multitasking to some extent, but reading chat window questions and trying to speak about Hurst cycles is something that I've never mastered. And so please forgive me if I don't respond to your chat questions. Sam is in there, our Chief of Support, and he will forward to me any specific questions that people are asking for me to answer. So please do put your questions into that window, and let's see if we can do that. I see some various different languages happening in the window, and it would be, there we go. Okay, I've got a translation into English. It's wonderful. I can see Piotr said we check to see if it works, which is probably vaguely what he said. And so let's move on, and let's get the show started. As today is our first live webinar, I thought that I would present you with an overall picture. When I start analyzing a market, when I'm about to make trading decisions, the first thing I do is I look at the overall picture. I think it's a very important concept, and so I'm going to do that in today's webinar. Thanks so much for all of your questions that were submitted to us using the various means that we use to gather questions. I do have all your questions, and I'm going to try to answer as many of them as I possibly can in the course of today's webinar. All the advanced questions, such as questions about intraday trading, I'm not going to get to in today's today's webinar. Let me that up front. In today's webinar, I'm going to be starting from the beginning. I'm going to be giving an overall picture of what Hurst cycles are. We have a very mixed audience. I realize we have a large number of newcomers, beginners, people who are completely new to Hurst cycles. I don't want them to think that this is really complicated. I don't want them to go away disappointed. So I'm going to try to provide some good introductory information. On the other hand, we have a large number of very experienced Sentient Trader users and Hurst cycle analysts. In fact, I've seen some analysts already here in the chat window who are better analysts than me, so I'd encourage them to speak up and get involved in the conversation. I have something for the more advanced users. I am going to surprise you all with some of the new features that are coming out very soon in Sentient Trader. So please disconnect if you are an advanced user, because I do hope that you're going to find some benefit in this webinar, even though a good deal of the material is going to be fairly introductory, sort of a beginning level. Right, so let's start speaking about Hurst cycles. What are they, and how do they work, and how do you make trading decisions? I'm changing the screen to show my screen. You should now be seeing a Sentient Trader screen, and I'm about to create a new workspace, and I'm going to load data from MetaTrader 4 for the S&P 500. In fact, this is for the ES futures. One of the questions that we were asked is what's the difference between the ES futures contracts, SPY, the Spider, and SPX? There are differences, and they have to do with the size of trade, the minimum tick move, and you can see here in my set, the minimum tick move that I'm loading for the ES futures is 0.25. The monetary value of that tick is $12.50. The big difference between the SPX, the SPY, and the ES future is that you will have different tick sizes and different monetary values for each tick. And that's the fundamental difference. There are other subtle differences and small differences, but they are all linked to the same fundamental index, which is the S&P 500 index. Okay, so let me create a new chart, and there is a chart of the S&P 500, in fact, the ES futures. Now, if we take a look at that chart, let me see if I can switch on this. I love scribbling over charts, and let me see if I can do that. It doesn't really seem to want to change the color. There we go. Okay. And so if we have a look at this price movement, I haven't applied an analysis or done anything to this yet, but looking at the price movement, you can see that there are times when price moves up, times when it moves down, up, down, up, and down. Now, that's a really wobbly line. I apologize. I have two monitors on this computer, and this pen drawing pad is terribly bad with two. At any rate, you can see cyclical action. There is something which is causing price to move up and then move down again. And that's the basic concept behind a Hurst cycle analysis, is that something is influencing price to move up and then to move down, and then to move up and then to move down. Okay, let me switch the display and do another quick drawing for you over here. And here we go. A normal cycle looks something like this. It has a trough. Oh, and it doesn't really want to draw for me. It has a trough, and then it moves up to a peak, then it comes down again to a trough, up to a peak, and down again to a trough. That's what a cycle is, okay? Very simple, moving prices up and down. So the fundamental concept behind Hurst cycles is that there is something that is causing prices in a financial market to move up and then move down again in a fairly regular manner. Now, I use the word fairly because it is not perfectly regular. Financial markets do not work like clockwork. And one of the really big things is that you get varying wavelength. What is the wavelength? The wavelength is the distance between two troughs. Okay. The wavelength is also, of course, the distance between two peaks. because in this little diagram that I've drawn you here, those two distances are the same. Okay, the distance between two troughs and two peaks is the same, and that is called the wavelength of a cycle. Now let's go back to my screen and let's talk about Hurst cycles in this market. These are the ES futures, the S&P 500 index. So price has been moving up and down, but it doesn't look very regular. And that's one of the fundamental concepts of Hurst cycles, is that there are many, many different cycles that are working at the same time to influence prices to move up and then move down again. And it is the way in which those cycles combine price movement. So I'm going to do is I'm going to use Sentient Trader software to perform an analysis. So I click on the Analyze button, which I know you can't see. I've chopped it off the window. But the software is now doing an analysis of this price movement. And then we're going to take a look at the analysis, and we're going to consider what the analysis means and what it tells us about what is happening in the market, what has happened, and what it tells us about what is likely to happen moving forward. There we go. It has performed the analysis, and so I'm just going to save this workspace so that we have something to look at. And let's change the resolution of this chart so that we can see a monthly picture. Right, now do you see these diamonds at the foot of the chart? Those diamonds are, of course, the positions of the troughs, cycles. In other words, the low points, the low prices, where the cycles are causing price to form troughs. Okay, the first thing that you will notice, and let me just remove this drawing and scribble on the chart again. The first thing that you will notice is that some of the troughs that have been marked by these over here are indeed very important troughs in the price, such as that trough in March of 2009. Some of the troughs that have been found by the analysis, such as this trough over here marked by these diamonds at the foot of the chart, are in a position does not look like a very important trough. Why is that? It's because of the combination of multiple cycles, and it's a really important thing to bear in mind. Cycles, according to Hurst's cyclic principles, never disappear. So you don't have cycles that appear for a while and then they disappear. Most people who start trading with cycles will find a cycle that they like, perhaps a 40-day cycle, and they'll start trading that cycle, and it'll go very well, perhaps for a few iterations of that cycle, and then suddenly that cycle disappears. And many people are left feeling disillusioned with cycles because they ask themselves, well, what happened to the cycle? I was trading it, I was making money out of it, but it disappeared. Remember, cycles do not disappear. They are squashed and influenced by other cycles, because there are multiple cycles that influence a price action. So if a particular cycle does not cause a very prominent trough in the market, or a very prominent peak in the market for that, then it is because of the other cycles that are also influencing the market. Now, just a quick aside, I do hope that you're not being disturbed by the jackhammer, which is pulling up the cobbling outside my office in the medieval town of Mogliano in Italy. A group of road workers arrived this morning and they've started jackhammering. Please let me know if available and I will change the microphone. But this microphone is, I believe, the microphone that gives me the best audio. Let me know if it becomes a problem and I will change the microphone. Okay, and so I've been having a lot of conversations with them asking if they can't extend their lunch break. Okay, so let's clear that. Now we have analysis, and the results of the analysis are presented at the foot of the chart. What is a Hurst cycles analysis? Very simple. It can find in the market, in the price action, and it works out when the troughs of those particular cycles formed. It marks the position of those troughs by means of these diamonds at the foot of the chart. The taller the pile of diamonds, the longer is the site is forming a trough at that particular point. Now, what are these cycles? Are they just a random arbitrary list of cycles? Does the software just say, oh, let's see what cycles I can find? No. The cycles that the software finds in the market are related to what Hurst called the nominal model. The nominal model is very simply a list of cycles. And if you take a look at some of the video material on our website, you can read all about the nominal model. But there is that in the price actions of financial markets. And that list of cycles Hurst discovered in the 1970s when he performed lots of tests on mostly American stocks, the prices of American stocks in the 1970s. And he performed lots of tests, forms of spectral analysis, and he analyzed the stocks to find out what cycles were present in the market. He combined the results of all of this, and he came up with a list of the average lengths of the cycles that are most commonly found in stock price movements. That is what we call the nominal model. Okay, I see Jules says, when is the next big trough? I can answer that. I noticed that popping up. You can see here the next big trough is over here. That's the next big trough over there. A really big trough. That's a trough of 54-month magnitude. So let's speak about the cycles that are played on this chart at the moment. The cycles that are the longest cycle that is being displayed is this orange cycle, which is the 54-month cycle. Okay, and these semicircles I find useful visual aids because they show us very roughly what each cycle is doing. So that 54-month cycle, you see, caused prices to move up in this period. Over here it was nothing, and during this period it was causing prices to move down. And same thing with this iteration of that cycle over there. Those semicircles are purely visual aids for seeing what the analysis is telling us is happening in the markets. Let me zoom in a little bit and analyze this analysis in a little more detail. I always like to question an analysis once the software has performed the analysis to understand it properly, what is actually going on. So let's zoom in on this period over here. Now, I understand for those of you who are beginners and newcomers to Hurst cycles, this might still be looking a little bit confusing, but I hope that we are very quickly going to be able to sort out that confusion. There's some very important points to be made about what we can see on the chart here. First of all, this orange semicircle, as I've already mentioned, is a visual guide to what the 54-month cycle was doing, because it formed a trough over here, according to this analysis, in March of 2009. Here you can see the low point in price, March 2009, just below a level of 700, and the 54-month cycle formed a trough at that point, as you can see from the pile of diamonds, and that at the top of the pile of diamonds is the orange-colored diamond, which tells us that is a trough 54-month cycle. Here is the next trough of the 54-month cycle, which according to this analysis occurred at the end of June or perhaps early July of 2013. The 54-month cycle was going up, going flat, and then going down again. Now, the first thing that you will notice when you look at the price movement relative to the analysis is that here, where there was a big trough of the 54-month cycle, there wasn't a really big trough in the price movement over there. Why is that? It is because of the combination of multiple cycles. That is pretty much always the answer to that question. If you look at a price movement and the size of the trough just as impressive as it should, usually it is because of the combination of other cycles. And there are some more sort of complex approaches to that question. I've given you a very simple answer. There are some more complex answers, really, which are more detailed, such as the fact that that 54-month cycle was probably part of a mid-channel pause. But I don't have time to get all of that today, so let's just keep moving on. But it's an important point to remember that cycles never disappear. That 54-month cycle did not disappear, but sometimes they get squashed by the other cycles. Now, next really important point about this analysis is that you can see here is the 54-month cycle Okay. Now, shorter than the cycle, we have the next shorter cycle, which in this case is an 18-month cycle. And the ratio between the wavelength of the 18-month cycle and the 54-month cycle is 3 to 1. Now, most of the ratios between the wavelengths in our nominal model is 2 to 1, which is much easier. Each cycle is half the length of the longer cycle. The 18-month to 54 months are the only two cycles that have a relationship of 3 to 1 in the end-of-day model. But this is how it works. Within each 54-month cycle, which is this big cycle here, there must be 3 examples of an 18-month cycle. 1, 2, 3. Can you see those 3 cycles nestled within the 54-month cycle there? Okay. And that is how Hurst cycles work, is that generally you start looking at the longest cycle and then you look at more and more. And Hurst cycles work kind of a fractal, which means that at each level it's a little bit like the same pattern repeating itself at multiple different levels, different time frames. Let me show you. So here we have an example of the 54-month cycle. Let me zoom in and take a closer look at this 18-month cycle. Now, can you all see this is an 18-month cycle? Okay, there is 18-month cycle diamond indicating a trough, and here is the other 18-month diamond. So over here is the yellow semicircle for the 18-month cycle. Now, that is the 18-month cycle. And within that 18-month cycle, there must, of course, also be shorter cycles. There is always a shorter cycle to consider, as there is always a longer cycle to consider. Let me show you how this works. I'll change the resolution of this chart to daily so that we can see how this is playing out in the markets. Here is 18-month cycle over there. And within the 18-month cycle, there are 2 40-week cycles. There's the first one, and there's the next one. 40 weeks is the cycle which is shorter than the 18-month cycle. So there are 2 40-week cycles, 1 and 2, which play out within that 18-month cycle. Now, let's speak about what cycles actually do to prices. Yes, of course, cycles push prices up and then they push them down again. But the result of them doing that is that they tend to form a shape which is a little bit like a capital M. So let me clear that. Here is a capital M, of course, and cycles form capital M's in the price movements. And let me explain to you why that is. Here we have the 40-week cycle moving up to a peak. That is the peak of that 40-week cycle. Then we have it moving down to a trough. Then we have the next 40-week cycle moving up to a peak, and then that moves down to a trough over there. Can you see that is a very twisted M shape? It looks a bit like the M shape that would be written by my 3-year-old. Okay, it is nevertheless an M shape which is playing out in the markets. And we're going to zoom in, and I'm going to show you how this happens at every level. Now, the important thing to bear in mind is that we can know what cycle shape to expect at any time. Let me clear this and show you what I mean. Within this 18-month cycle over here, we expect an M shape. Okay, that's an M shape that we expect within that 18-month cycle. But can you see that for the first half of the 18-month cycle, during this 40-week cycle over here, the 18-month cycle is going up. So we would expect strong bullish move, market up. In the next 40-week cycle, which is this cycle over here, on the other hand, we would expect less bullish pressure, and we would expect the cycle to actually be slightly bearish. Let's see that happened. First of all, the first 40-week cycle M shape has a very late peak. Can you see that? And it moved the market up tremendously. That is therefore very bullish. What about the second 40-week cycle M shape? It moves up to a peak here and then down to over there. Can you see how that is much less bullish? In fact, it is slightly bearish because the price movement from the start of the 40-week cycle to the end of the 40-week cycle ended up bringing price lower. That is therefore a slightly bearish M shape. So you will constantly get that pattern. A bullish cycle followed by a less bullish or bearish cycle. Now, let's zoom in and see how this keeps working at many different levels. If I zoom in to the next cycle, the 40-week cycle, then here again, we can see a 40-week cycle from the trough over here all the way to this trough over here. Notice how this trough doesn't look very impressive, but I've already mentioned how it doesn't always look very impressive. The important thing is that a trough formed at that time in the market, and that trough is probably a trough of the 40-week cycle. Now, the two shorter cycles than that 40-week cycle that fit within it are the 20-week cycles, and here they are. Here's the first 20-week cycle, and here's the second 20-week cycle. We expect to get a very bullish 20-week cycle. That's quite nice and bullish. And then a less bullish. Well, that wasn't less bullish. It looks just about the same length of bullishness. Sometimes there are exceptions to the general rule. Sometimes we get a cycle which surprises us by its bullishness. But the general principle remains. And if we zoom in, we will see at an even shorter cycle level of detail. Here is the 20-week cycle. Okay, and in the 20-week cycle we had two 80-day cycles. There's the first one and there's the second one. Two. Okay, how bullish was this first 80-day cycle? Very bullish. How bullish was this second 80-day cycle? It was slightly bearish. Okay, I could continue and I could keep zooming in, but I think it's time for us to move on and start considering this analysis in a little bit more detail. Now that you understand, I hope, the way in which the cycles work together, let me zoom all the way out and we can consider this analysis in terms of what it is saying is happening to the general picture of where the S&P 500 is going. First of all, we have a 54-month cycle which formed a trough over here. That's the longest cycle that has been found in this particular analysis. If we had more data, we could have found longer cycles, but this is enough cycle information for us to make a very informed decision. The next 54-month cycle trough then occurred over, so it's a very skew line, then occurred over here. At this point, I like to zoom in and, to see what has been happening in the current 54-month cycle. Let me change that to weekly. Now, as I've mentioned, each 54-month cycle consists of 18-month shorter cycles. So here is the 54-month cycle. Now, it's to come down to a trough somewhere over here. And these semicircles are very useful because they can be used a little bit vectors. Let me show you. If you consider today, which is over here today, right over here, you take a look at the semicircle, you ask yourself, what is that semicircle doing? You can see this semicircle today is moving pretty much horizontal. That indicates that the 18-month cycle is not really influencing the price to move up or down at the moment. Now within this 54-month cycle, it's trough here at the end of June 2013, we expect three 18-month cycles. Here is the first one, and here is the second one. Now you can see the second one formed a trough according to this analysis in October of 2014. And we are about halfway through the cycle. Again, we can apply the principle of these semicircles as being vectors. And you can see that as of today, which is over here, I can't really draw a vertical line here. As of today, this 18-month semicircle is heading down slightly. That indicates that the 18-month cycle is probably beginning to apply some downwards pressure. Good. All right, so now let's question this analysis slightly. Let's ask some questions of this analysis. I don't believe that you should just immediately assume that Sentient Trader has performed the perfect analysis. In particular, let's zoom in at this period over here and ask ourselves whether this 54-month cycle trough is really in this position over here. Is that really the correct position for that 54-month cycle? Well, it could be, but that implies that we had one 18-month cycle of a normal length over here, a second 18-month cycle of normal length, and then we had a stretched, much longer 18-month cycle. Is it not possible that this 54-month cycle trough occurred over here? Yes, indeed, it is possible. And so we need to take a look at that option. Now, I'm not going to have to rebuild this entire analysis. So what I've done is I have done this exact process in advance. And let's switch over to that workspace and take a look at that analysis. First of all, here's the chart that we have just been looking at. You can see at the top of the chart, I have called this the default analysis. There it is. This is the default analysis. And here is that rather troublesome 54-month cycle trough here in June of 2013. Now, we know that cycles make M shapes in the markets. And can you see this beautiful and perfect M shape over there? Is it not possible that that 18-month cycle trough in fact formed over here in, what is that, 2012? Yes, it is perfectly possible. And in Sentient Trader, you can get the software to perform that analysis. Fortunately, I've done that for us already, so we don't need to sit wait while we do that. We can simply take a look at it. I've called that analysis the early 54-month cycle analysis. And let me just zoom out and show you. Here is analysis with that 54-month cycle trough at this earlier position over here. There it is over there in November of 2012, a trough of the 54-month cycle. Now that we have two possible analyses, we can start asking ourselves what is going to happen now. One or other of these analyses is almost certainly correct. What does it mean about what's going to happen now? And of course, that is the punchline, because we need to ask ourselves what is going to happen now and what's going to happen next, so that we can make correct trading decisions on the basis of that information. So let me zoom out slightly and let's consider these two analyses. First of all, let's go back to our default analysis, and let's do that and go back a little bit. And I do see questions. I'm going to get to some questions in just a moment, and let's zoom out. There we go. Okay, so let's take it one more step. Let's look at the bigger picture for this particular analysis. This particular analysis, we know, places a 54-month cycle trough over here in June of 2013. We have a 54-month cycle which has been lifting prices, is now going flat, and is soon going to be going down again. Okay, within that 54-month cycle, we have 3 8 cycles. Here is the first one. From there to a trough in October of 2014, and here is the second one. That cycle is also now flat and is about to turn down. Okay, so we also know that we tend to get a progression from a very bullish cycle. Let me just clear this. We get a very bullish cycle as the first one. That's a very bullish 18-month cycle. Then we get a less bullish 18-month cycle, and then we will get a bearish 18-month cycle. Now that blue line that I've very roughly drawn there shows what these cycles are telling us to expect from the market. So let's just spend a moment thinking about, it's telling us to expect a bounce now out of this trough here, which formed at the end of August. So we're expecting a bit of a bounce out of a 40-week cycle trough. It's important to remember that a bounce out of a 40-week cycle trough will not last for half the duration of the cycle because of the pressure of the other cycle. When other cycles are pushing down, and we can see here that the other cycles are pushing down, the 18-month cycle is pushing down, no question about it. The 54-month cycle is also beginning to push down. So when the longer cycles are pushing down, that means we should expect an early peak followed by an extensive move down. We're expecting more bearish cycles to develop. Now, you could simply make trading decisions on the basis of that very rough blue line that I've shown you, but that's just a very rough, it gives us a picture of what to expect. That's what I expect out of this market. Let's take a look at our alternate analysis and see whether the alternate analysis is something very different, because if it does, then of course we need to reconsider the fact that we are expecting, which, as you can see, according to this analysis, is pushing down with a little more strength. It's the first 18-month cycle, which was a very nice bullish cycle. Here is the next 18-month cycle, which was a bullish but not very bullish cycle. So it was less bullish than the first one. What do we expect next? We expect an even less bullish, probably bearish cycle to develop next. Again, this blue line that I've drawn for you shows what these cycles tell us to expect in very simple terms. Okay, so we are expecting the market to bounce up a little bit now and then to turn down again. Okay, that gives us a very broad picture about what we should be expecting. Now, let's make some trading decisions. Let's start with our default analysis, and we're going to begin to make some very simple trading decisions. First of all, let me zoom in here and show you in a little more detail what is expected to happen in the near future. Okay, here you can see we have an analysis that shows us the formation of a 40 trough here in August of this year, just a few weeks ago. Now, before you all jump online, perhaps you have already in the chat window. I haven't been keeping an eye on the chat window, but before you all jump online and say, hang on, what about this trough here as a 40-week cycle trough? I am going to come back in a few minutes and I'm going to consider that possibility. Let's for now just stick with the concept that this trough over here in August was a 40-week cycle trough according to this analysis, and let's ask what trading decision we would make. At its most basic level, when you're going to make a trading decision using Hurst cycles, you first ask yourself, what are the cycles telling me is going to happen in this market? And as I've just indicated, I can draw very roughly my expectation, and that was a bounce up followed by a fairly strong drop down. Okay, therefore my trading opportunity in the short term, immediately, my trading opportunity is perhaps to make a long trade to catch this bounce out of the 40-week cycle. However, the longer cycles are pushing down. Can you see the semicircle of the 18-month cycle? That's pushing down. The 54-month cycle, even see it's at the top of the chart, but we know that is also pushing down. Therefore, because the longer cycles are pushing down, it might be more sensible to wait until this bounce has completed before we actually enter into a short trade. Why? Because my bigger picture for what is happening in the markets at the moment in the S&P 500 or the ES future is that we are going to see a strong move down into the end of this year and probably into next year as well. So how do we make a trading decision? Well, there are many ways, and I'm going to spend many webinars, I'm sure, talking about all the possible ways to make trading decisions. Reliable methods that I use is with interaction with the FLD, and many of you are familiar with this, so I will speak about it really very, very quickly. But the FLD is a line, it's a very powerful line, and it stands for the future line of demarcation. And price tends to interact with that line in a fairly regular manner. Now, following a bounce out of a 40-week cycle trough, we would expect price to cross above the FLD. It has fairly significantly failed to do. Can you see? Oh, I've been scribbling all over this chart. You can't see a thing. But it has significantly failed to really cross this line in any very meaningful manner. What does that mean? That means that probably the bearish pressure on this market is even greater than one might assume, assuming that the market is bouncing out of a 40-week cycle trough. Price has been pretty much following this FLD, and it is still pretty much attached to that FLD. We do expect price to climb up above it. It is a little bit up above it in before I was trading, to a little bit up above it. But am I feeling good about entering a long trade at the moment? Am I expecting the market to shoot upwards? No. Remember, the bigger picture is that we are expecting a bounce out of this 40-week cycle trough, but the longer cycles are pushing down. And if the longer cycles are pushing down, then probably the most profitable in the near future are the trades on the shorter side. So we need to find levels at which we enter. The level at which I would enter a trade would be at the level of this 20-day FLD. And you have many levels to choose from, and in future webinars I will definitely be speaking about this in greater detail. But for me, at the moment, my trading decision in this market is because the market is currently enjoying a bounce. You must always remember to look ahead at what's coming next. What's coming next, in my opinion, is a move down. Therefore, I'd be looking at entering into a short trade. It would be a D category short trade for those of you who are following Hurst signals or the FLD trading strategy. That's a D category short, and can set myself an alert at the level of this FLD perhaps, and I will be sent a message when price actually crosses below that FLD, and that is the point at which I would look at entering into a short trade. Wow, so I wanted to try to get through all of that in half an hour. It's taken me 40 minutes already, so I'm running over time, but let's I'm going to turn to questions in a moment. Before I turn to questions, I've presented two possible analyses here. Let me go back to the other analysis. Important thing to consider when you have two possible analyses is whether that affects your trading decision. Is your trading decision to be influenced by the fact that you chose the wrong analysis? Are you going to lose money because you chose the wrong analysis? We've already seen how the general outlook for what's coming next in the market is very much the same for both of these analyses. And just to remind you, this analysis is bouncing out of an 18-month cycle trough. Oops, I better clear that. Bouncing out of an 18-month cycle trough, we expect a bit of a bounce up. But more importantly, we expect a fairly strong move down again. Okay, so what is my trading decision on this chart? Well, or on this analysis, again, I would display the FLD, and let's take a look at the 20-day FLD. Here is the 20-day FLD, and again, I will be making my trading decision on the basis of this 20-day FLD. Can you see how the FLD is in the same place? Can you see how my trading decision is actually the same, even though I'm looking at a different analysis? It's only a slightly different analysis, admittedly, but I believe are the two most likely possible analyses. And again, my trading decision is going to be to enter short as price crosses the level of this FLD. So again, I can set myself an alert, or I can even generate an order at the level of this FLD. For now, I'm just going to generate an alert. I'll be sent a message to my cell phone, and you can have them emailed and so forth when price crosses that level. Now, let me take a look and see if there are any specific questions about any of the stuff that I've spoken about so far, and have a look. All right. Sam is collecting questions that he feels I should answer. So I see a question from Suresh. What would be the direction of the S&P 500 for the rest of the calendar year? Right, great question. Let me zoom out and show you the bigger picture here. And here we go. And so you asked for the rest of the year, so that's up until the end of 2015. Let's sort of go to the middle of next year. Let's just try and incorporate some fairly big cycles there. Okay, what is the direction for the rest of the year? Well, according to this analysis, as I've already indicated, let me turn on my semicircles. I find semicircles really very useful for considering the longer term questions. Okay, there we go. So I've mentioned here is what we expect to happen, and prices bouncing out of clearly either an 18-month or perhaps a 40-week cycle trough at the moment. It is going to go up, but I don't expect it to go up very high. Why? Because this is the third 18-month cycle in the current 54-month cycle, and it is expected to be a bearish shaped cycle, which means it will go up, it'll form an early peak, probably fairly soon, and then it will move down and drop to a lower price. Okay, so you asked until the end of the year. Whoops, that's a terribly skew line. That's about the end of the year. So that's my outlook for up until the end of the year in the S&P 500. Now, I want to take a quick diversion and speak about, let me turn that off. Let's take a quick diversion and instead of just presenting the analysis and banging on and on, I over the years have been drawing things on these charts. If you've seen videos of mine, you know that I'm constantly drawing on these charts, and I'm doing what I have just been doing in this webinar, which is I've been drawing lines indicating where I expect the market to go. And a new feature that is coming to Sentient Trader, and this is a moment for the Sentient Trader users out there, a new feature that is coming to Sentient Trader is very, very exciting in my opinion. And it shows you the results of the cycle analysis condensed down into one single line. It's a very exciting feature I'm going to show to you in a moment. But in order to introduce that feature to you, I need to show you another very exciting feature in Sentient Trader. So make sure you're sitting if you're a Sentient Trader user, because this might just blow your socks off. And the new feature is the ability of Sentient Trader to perform not only a trough-based analysis, but to also perform a peak-based analysis. I'm not going to go into details in this webinar. We will be introducing these features to our users and asking for beta testers later on this week. Let me show you what it looks like. And here is the result of an analysis that has been performed on this chart using both troughs and peaks. Now, if you're a Sentient Trader user, you're looking forward to getting this particular feature, because it is a very, very exciting feature in my opinion. Very often, you know, when you perform an analysis and you're analyzing only troughs, and somebody asked the question, why did Hurst define, why did he declare the principle that troughs are synchronized and not peaks? That's a complex question, and I'm not going to get to it in today's webinar, I regret. It's a very important question, but I'll talk about it in an upcoming webinar. But very often when you look at a trough-only analysis, you feel as though you're only seeing half the picture. Because what about those peaks? What is the peak that this market is falling out of? Now, for those beginners out there, I apologize if this is beyond your level of understanding, but for the old hands, if I can call that, I hope this is looking interesting, because finally you can answer the question, what is the peak, or let me turn off those semicircles that can be a bit distracting. You can finally answer the question, what is the peak that we have just seen in the markets? And that question is answered very clearly by this analysis. Here is the peak in the S&P 500 in May of this year. Can you see the magnitude of that peak? 54 months, the longest cycle the software has found, formed a peak in May of this year. Now, a lot of us have been talking about the magnitude of that peak and discussing whether it's the peak of the 9-year cycle, as I see David's mentioning. But finally, we have good reason to actually really understand what magnitude that peak is. Right, let me hide that because that's a topic for a completely separate discussion. But having introduced you to that feature, let me introduce you to another feature. This is the most exciting feature since Sentient Trader came to existence. It is called the composite model line. There's a huge amount of information that Sentient Trader has as a result of the analysis that it has formed. A huge amount of information. It knows what the wavelength is of all these cycles. It knows what the amplitude is of each one of these cycles. It knows how the amplitude has changed over time. It knows how the wavelengths have changed over time. It knows a great deal of things. And for years, all it has done is presented those diamonds at the foot of the chart. However, it is now able to present that information in a very useful new way. And let me see if I can get this to do it. There it is, ladies and gentlemen. That is what is called the composite model line. That line tells us what would happen if you took all the cycle information that the software has and combined that information to produce a price line. Okay, perhaps I'm the only person who feels excited about this, but it is a dramatic step forward for Sentient Trader and for an understanding of what cycles do in the markets. And if I zoom all the way out, we can see this composite model line going all the way to over here. As Silent One says, now you don't have to visualize it. That is exactly the point. I've spent years drawing on the chart saying, well, look, you see, this is what's going to happen. And this composite model line means I don't have to draw it anymore. So I'm replacing myself. But there are many things to say about this composite line. It's a very complex concept, and I shouldn't have introduced the last 10 minutes of today's webinar, but I'm excited about it. I look forward to you testing this line. But you will see that the line sometimes matches the price movement perfect. Look at this period over here. The price movement is matched perfectly by the composite model line. Then there are other times when the price movement diverts from the composite model line over there and over there. That is because the cycle information that the software has perfectly matching the actual price behavior. You can see there as well. We get a discrepancy between the two lines. I've been playing with this tool for quite a long time, and I've been biting my tongue. I was told not to. Anyway, too bad I've mentioned it. Here it is. It's an extraordinarily powerful line, and you can see how the cycle information that the software has in it, how closely it matched what actually happened in that market. Okay, so there's a really, really exciting development for Sentient Traders to look forward to. We're going to be launching this in the next few weeks. I'm going to be inviting you to test this composite model line fairly soon, sometime in the course of this week. But the really exciting thing about this composite line is it enables us to look into the future. Now, lots of disclaimers here because the software uses the current cycle wavelength to know what's going to happen in the future. That's very important. It doesn't know how the wavelength is going to redraw. It doesn't know how the wavelength is going to vary. I was reading the chat window. I shouldn't do that. the software does not know how the cycle wavelength is going to vary. It does not know what's going to happen to the amplitude of these cycles. It uses it to make its best guess, and I can explain that in detail at a later time. But here is a simple answer to that question, which is a question that everybody has. What is going to happen in the future? Well, if the cycles don't vary, then this orange line that you see is what is going to happen in the future. It's as simple as that. I've spent the last few years drawing squiggly lines, and I'm very excited that Sentient Trader will now do it for itself. Of course, a really important thing is that that assumes that the cycle wavelengths are not going to vary and that the amplitude is not going to vary. And if there's one thing we know about the markets, we know that the cycle wavelengths are going to vary and the amplitudes are going to vary. So that line is wrong before you even start, but it gives you a very good indication of what to expect, or more to the point, it gives you a very useful way of understanding that analysis. For years I've been talking about those diamonds and those nests of lows and trying to explain what it means. Well, there you go. In that orange line you can see exactly what it is. Let's just mention something else quite useful and important about this composite model line. Do you notice how over here, for instance, the bounce out of the 18 cycle trough, price up above that composite model line, right? Which indicates that the markets surprised us to the bullish side, all right? If you had been trading as a matter of interest, if you'd been trading the low troughs and peaks of the composite model line, you would have done very well. Then you can see the sort of consolidation that happened over here, sticking very closely to that composite model line. Then over here, price again pulled up above the composite model line. But you notice what has happened since, what is that, March of this year. Price has been disappointing on a consistent basis. It dropped right down below that composite model line. Now, this is going to be a really, really exciting new feature for you to experiment as a Sentient Trader user and a Hurst Cycles trader, and I look forward to hearing your feedback. But the fact that that price deviated to the downside so dramatically is a really clear indication to my mind that the markets have started turning bearish. So again, using this composite model line, I come to the same trading decision. And let's just zoom in here. I come to the same trading decision, which is that I do expect the markets to be bouncing out of this trough over here at the moment. I expect them to peak. Can you see when that peak is expected according to the composite model line? It's expected next week. Okay. Now, whether it happens next week depends on how consistent the cycles remain. They might very well change. But we are expecting a peak soon. So again, I emphasize, I'm not jumping into a long trade at the moment. Yes, we might see some bullish movement, but I'm looking forward to not this short, quick 1 week move, but I'm looking forward to this really big move that drops down over there. Okay, and that composite model line gives us a really quick visualization of what's expected in the markets. So I probably could have made this webinar shorter just by showing you the composite line at the beginning. But I do hope that you found that introduction to an analysis of the ES futures, S&P 500, really useful. I hope that I managed to cover enough introductory concepts to keep all the beginners with us. And I hope I've given something to the more advanced Hurst Cycles analysts and Sentient Trader users to keep you interested and excited. Let me quickly see if I can answer any more of your questions. I've seen lots of questions come flying into that window. Let's see questions I can answer here. I see a comment from Silent One. Silent One, everybody, I'm going to embarrass you now, but he is an extremely experienced Hurst Cycle analyst. And when Silent One says something or mentions an analysis, I always sit up and pay attention. In fact, I have a confession. When I first started using Hurst Cycle, I didn't trade on the basis of my own analysis for some time. I traded entirely on the basis of Silent One's analysis. He says, I think David should mention that Hurst's nominal cycles can run at shorter cycle periods. For example, the 40-week cycle could be running 33 to 34 weeks. That's a very important concept. Cycle wavelengths are constantly varying. And so I say a 40-week cycle doesn't mean it's going to take 40 weeks to play out. Cycle wavelengths are constantly varying. Thank you. Very, very important point. And I see a message from David Hurst. The proposed next 54-month trough would also be a 9-year cycle low, assuming the low in 2009 is a 9-year low. Very, very important point, that next 54-month cycle trough. And let me just zoom out here on this chart. Let me turn off that line because it's so distracting seeing it. And let's go back again. The next 54-month cycle low is probably going to be a low of the 9-year cycle as well. Very important point. Thank you. Piotr, I'm not sure how to pronounce your name, Piotr. Perhaps it's more like Peter. Estimate amplitude strength high of the 54-month cycle. And William points out that one needs to use a bandpass filter to extract the waves in order to see the amplitude. That's a really fantastic. Thank you very much for making that point, William. Bandpass filters are where Hurst cycles analysis all begin, if you like. A band is a mathematical process for extracting cycle information. I believe I'm correct in saying it's used for extracting, radio wavelength information and so on. From white noise, and it's a very useful method for extracting information about cycles. Sentient Trader performs a basic form of bandpass filter, or a form of spectral analysis. I know there are differences, and I don't really want to get them mixed up. Let me just show you how Sentient Trader can now present that information to you at the foot of the chart. Okay, there is the 54-month cycle, the results of the bandpass filter, or the spectral analysis that Sentient Trader has performed. I shouldn't really call them the same because they're not, but here are the results of that analysis. You can see that there are cycle lines here, and there are in fact 2 of them. That's because I've performed a double analysis in this chart. Remember, an analysis with troughs and another analysis with peaks. So the trough analysis line is this one here, and you can see the amplitude. That is not to scale, I should point out. You can see the amplitude of that 54-month cycle over there. This is another of the new features that we'll be testing in Sentient Trader in the next few weeks. And there, as a matter of interest, is the 18-month cycle amplitude, if you like. And if we zoom in, we don't even need to zoom in. I can just take off the 54-month cycle. Notice how the 18-month cycle amplitude has been getting smaller and smaller over the last 2 or 3 iterations of that cycle. Okay, so that's another exciting feature, and it will answer the question of what is the current strength of the 54-month cycle. Okay, and so Jonathan has said it would be interesting to see 54-month cycles from 1980s to date. I agree, and Jonathan, in a future while, I have been asked to do to specifically address an entire webinar at a really long-term picture. So I'm going to load up data from as far back as I can get it. When we tested Sentient Trader in the old days when it was called the Hurst Trader, some of our beta testers loaded data from 1898 up until the current date. That analysis takes quite a long time, but I'm going to come back and I'm going to look at those longer cycles. So I agree, it would be very much very useful to look at the very long cycles. I'm not going to have it today because my time is indeed already up. And a comment from David, we really should have a hashtag for this webinar, so people talking about it will be collected on Twitter. That's a really good point, David. You know, hashtags and Twitter, I'm going to reveal my age. I'm terribly confused about all of that, but I'll send you an email and ask you if you can help us do that, because Twitter and hashtags and everything is all a little bit beyond me. Okay. And Jules is asking, when is the next peak on the SPX? Well, I hope that I answered that just a few minutes ago by showing that composite line. And let's show that composite line again. And let's just reduce the number of cycles used to create the composite line. But there it is. There is the next expected in the SPX. Next week, and then of course we're going to get a constant series of peaks. Look at this, we're going to get a peak in September of next year. Okay, so that is when the next peak is expected. Remember that of course cycles give us an indication of what is happening, but in my opinion cycles are not absolutely perfect. I know there are some people who swear by cycles and swear that their analysis can be accurate to within minutes. I've received emails from people who claim to have predicted the low in March of 2009 to within half an hour. My approach to cycles is not quite that accurate, but it's certainly accurate enough to make very profitable trades. And so that line gives us an indication of what we're expecting to happen next. Okay, now we've got a question from Sid. What if the 40-week cycle trough happened earlier? Great, thank you for bringing that up, Sid, because in fact I believe 40-week cycle trough happened earlier. Now, if you're a newcomer or a beginner, I do apologize if this is going to suddenly start getting a little bit complicated. But it is perfectly possible that the 40-week cycle trough, in fact, occurred here in July. And if we count the bars from the trough in October to that trough in July, that is 263 bars. The average length of a 40-week cycle, you should all know, is 274 bars, or 274 days. So the 40-week cycle trough was expected to occur, if the cycles were absolutely exact, on the 17th of July. So the software has itself, or we as analysts have to ask ourselves what happened if the 40-week cycle trough could have occurred 10 days early over here on the 6th of July, as opposed to occurring 40 days late over here in the last week of August. So here is an analysis. In Sentient Trader, of course, you can pin a trough. This little pin symbol means at the foot of the chart. Let me just draw a circle around it. There's that pin. So it means I've pinned that trough there. That means I've asked Sentient Trader to position the 40-week cycle trough there. What does it mean? What are the implications of that? Well, fortunately, we have our very fancy new composite line that I can put up onto this chart, and I can show you exactly what that cycle model predicts is going to happen. Okay, and there it is. And so you can see that, again, we are expecting price to bounce up. And the peak in this case was expected also next week. Isn't that interesting? So even when you change this analysis, we're still expecting a peak next week, after which we're going to see markets moving down quite sharply into this 20-week cycle trough in November. Then markets should go pretty much sideways, slightly upwards until February of next year. And then in February of next year, that's probably when you need to stand by to take that really big short trade, because that's when things might go horribly wrong. However, there's something I'd like to point out about this analysis, and that is that this composite line is indicating that price should have started bouncing during this period over here. What has price actually done? Price has actually come all the way down here. That indicates the price has a lot more bearish pressure than the software is aware of. Remember, the composite model line is a combination of all the cycle information that the software has in it. So it combines all the information it has and it produces this projection for what's going to happen. And the fact that price has deviated so strongly from that projection recently indicates that there is a lot of added bearish pressure that the software is unaware of. Perhaps it is that 9-year cycle turning bearish. Who knows? Okay, but certainly there's extra bearish pressure. Pete says, if the composite line for future points continually adjusts, then that would naturally cause it to conform more to the actual price action in the past. That means the past will look better. Yes, of course. Pete, huge discussion to be had around the composite line. It's very important. I'm just quickly presenting it to you here. There's a lot of discussion to be had. I will be dedicating entire webinars to discussion of the composite line. What the composite line is it's a combination of all the information that the soft has about the cycles in the past. And you can look at that information, and it shows you what that information tells you about the markets, and you can see how closely they match and where they don't, and so on. So yes, indeed, but that's a really big conversation. All right, Jonathan asked a question about backtesting. Did the composite see the 50% fall in 2008 and 2009? I'll have to leave you to do that backtesting. I've just started working with it. It's an interesting project for me to do. I'll see if I can do that for our next webinar or one of our future webinars, and we can take that and discuss all of that. And okay, Sid Norris is saying, can you tell what exact day that peak is? The one that is set for next week on the composite line? Right, so well, let me just do that. Yes, I can. Peak. Bear in mind all the disclaimers. This is based on the fact that these cycles continue to move with the same wavelengths. It's not adjusting for that. So in fact, the current peak, according to this composite model line, indicates this weekend, Sunday the 20th of September is when we're going to see the peak. Okay, very few of us will be trading on Sunday the 20th of September, so you should probably get out of your long trades on Friday. But please bear in mind those disclaimers. Okay, I'm very worried about people taking the composite model line too literally. It is not a forecast line. It's not a projection. It's not at all. It is simply taking the information the software has and showing you how that information would have generated, or would have produced the price action that you see there. Okay. It is really time for me to start wrapping up. Before everybody goes, I'm going to continue answering questions for as long as I can, for as long as you can all stay here. Thank you so much for coming in today's first live webinar. I ran over time, of course, I'm afraid. I'm sorry about that. But before you go, before you say goodbye, please, would you complete this survey for me? The time for this webinar was based on surveys that we did previously, and I chose the best time. And what I've done now is I've got a very quick survey for you. I would love to know from all of you who are here today, which would be the best time for you. Because, should we do these webinars on a Tuesday? Would that suit you better? You can see for each day I've got 3 options. The option for each day is now. It's the time that we're doing this webinar. So that'll probably be the most popular, because of course you're here, so it is probably going to be the most popular. But it'll be very, very useful for me to see what would be the most popular time for you to attend these webinars. Because we have considered doing the webinars at a different time each week. I'm concerned that that's going to get horribly complicated and nobody's going to know what time the webinar is this week. I'm going to log in at the wrong time on the wrong day, and it's just going to be it's going to be a disaster waiting to happen. So please click on that survey. You should be seeing it in the right. Let me see. So as we wrap up today's webinar, I want to say thank you so much to all of you again for being here. To have you on today's webinar. I look forward to doing these webinars every week. Please help me to improve the webinars. Send us feedback. Send us emails about the webinar so that I can improve it. Make these webinars, just the most valuable resource for you. I really enjoy connecting with all of you, and I see Beth in Port Elizabeth. No, not Port Elizabeth. It is Elizabeth in South Africa. Hello, Beth. Thank you very much for joining me. I do hope that I managed to give you enough information for the beginners and tantalizing information for the more experienced amongst you. Thank you so much for being here. And if you do have further questions, I will be happy to stay on the line, but I know how valuable your time is. And so I'm going to start bringing the webinar to an end. Let me know as soon as you have finished that survey. In fact, I'm going to close that survey just now. Thank you so much for being with me. I look forward to seeing you next week. We're doing another one next week. Isn't that great? Okay, so send me all your questions. Let me know how I can improve these webinars, make them more valuable to me. Do we need more valuable to you? More introductory information, more focus, more advanced stuff? Anyway, thank you very much. Look forward to seeing you all next week. And with that, I am going to say goodbye. End that voting. And just a reminder, if you would like to learn more about Hurst cycles, don't forget to use our resources, our Hurst Trading Room podcasts, which are going to continue, and they will be slightly separate from these broadcasts. We have that document you can download and other introductory videos, of course. Thank you so much for being with me, and I look forward to seeing you next week. And in the meantime, I wish you, as always, profitable trading.